Hi, Professor Rex here with an update on our 2 dividend stock portfolios. You're looking at a chart of the growth of our weekly investments into our dividend growth stock portfolio that we started in 2022. Before we look at the dividend growth stocks we bought last week, overall, all of our strategies are beating the S&P 500 from their inception except for our tech stock portfolio. And we are still in a bear market, which means dividend yields are much higher and stock prices are much lower, many of which are at bargain prices. As I said in our last update, the market will eventually recover, so I'm definitely continuing to add to my portfolio each week, hoping the sale on stocks continues. So let's talk about the dividend growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. Now I list the top 15, but we only buy the first 10. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Those are MasterCard, Microsoft, and Allegiant. Remember, we use many criteria to filter stocks, and if they are hovering at the required level, a stock can make the list one week and then drop off the list based on a small movement in one of those metrics. Examples of criteria or metrics used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate would dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. So each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks we're purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, often called a drip feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. Now, this table on this slide includes a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this strategy easier. So my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks and the tech stocks. Last week I purchased $2,800 of these as I gradually transfer out of my main dividend ETF, which is ticker symbol SCHD, and buy these stocks instead. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% or so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend payers tend to be riskier because they are smaller companies, usually, not always. But studies have shown they significantly beat the stock market over the long run. Risk is the first quality component shown on this slide, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings. Earnings, remember, it's just a fancy word for profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. And let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works usually. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. Now let's look at the growth of our second dividend stock portfolio, this time a high yield stock portfolio. Like the dividend growth portfolio, we make weekly investments into the portfolio. As I've been predicting, the return of the high yield portfolio is starting to become very similar to our dividend growth stock portfolio, but just with a higher yield. I would suspect the dividend growth stock portfolio will eventually have the higher return in the long run, but they're definitely getting closer together. And the portfolios were started, I believe, 20 months apart. Now let's talk about the high yield dividend paying stocks we bought last Monday for our high yield portfolio. I posted these rankings on our website, beatthestockmarket.com, last Monday, and then we purchased the 8 stocks. One thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks. We have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of this stock getting a 1/8 weighting, they get 2/8, which is 1/4, equivalent to 25% of that week's investment. Now, both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought last week while implementing strategy 1 are Novo Nordisk, Comcast, PNC Financial, and Merck. And the 4 high yield stocks we bought last week while implementing strategy 2 are Comcast, PNC Financial, Merck, and State Street. As you can see, these 2 strategies have some overlap. And here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the month of February increased 70.2% over the same month a year ago. This chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our 2 main stock portfolios? The first reason is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion, that being that dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks on average. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, on the right side of the slide, you can see that the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios of dividend-paying stocks only invest in dividend-paying stocks that have increased their dividend recently. Along the same lines, BlackRock recently released a report showing that $10,000 invested in companies that increase their dividends, called Dividend-Growers, and companies that started paying their first dividend, called dividend initiators, grew to $2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So investments made in stocks that raised their dividends or started paying a dividend grew more than double than if the stocks were instead made in stocks that did not pay dividends. 116.7% difference to be precise. So not only do dividend-paying stocks historically have a higher return on average than stocks that do not pay a dividend, and they have less volatility on average, they also perform better than non-dividend paying stocks in down markets, also called bear markets, by 1 to 2% per month, not per year. This is very important because what causes investors to panic and sell at the worst time is when they see the value of their stocks plunge. But dividend paying stocks hold up much better in down markets than non-dividend paying stocks. This is from a report a study in the Journal of Corporate Finance. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which just increased its dividend for the second time last year and for the 14th consecutive year. Now, I bought Broadcom, a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning that for every $100 I invested in the stock, I would receive $5.01 each year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in quality dividend growth companies. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on my original investment, is now 31.81%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investments that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in the previous year. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. Another reason I started with a low investment amount per week was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74 per week. For our classroom dividend-growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, the inflation was even lower, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 on the first trading day of each week. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5, or maybe like 1 through 6 or 1 through 7. However, the downside is this reduces portfolio diversification, but some investors are more comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns by 45%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, you could try not limiting individual portfolio holdings to 4% of the portfolio's total value. So normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's rankings, as mentioned in bullet point 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved the annual returns by 55%. But again, I personally prefer a more diversified portfolio. Number 3, so the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and ReposiTrax, 97% gain also in 12 months, on average, they've not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks have not done quite as well as the dividend growers is because many of those under-the-radar stocks are very small companies, and small stocks have not performed as well as big stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could try selling when a stock is fairly valued, even if the dividend and quality metrics are excellent. So we don't sell stocks often in the portfolio and tend to only sell if the company cuts a dividend or the stock appears to be overvalued or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we're buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this fourth strategy is the most difficult to implement because you have to have your own valuation methodology, and then you also have to implement it on your own. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Now, most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually paid every other week, and it's automatically invested in their 401k. When I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. Now, the advantage of investing every week as opposed to every other week or monthly is you get more diversification. So if one doesn't mind less diversification in their portfolio, option one is to invest every other week or monthly instead of weekly. Option two is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. In other words, you would skip the under the radar dividend payers. Over time, some of those stocks will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. That's it for this week. In the comments, let me know if you have any questions, and also let me know what other portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update. See ya!